Hey everybody, investing without pain here, and coming at you with another video. I told you guys I'd be talking about selling covered calls, giving you some ideas of my strategy. I assume most of you may have heard about covered calls or selling calls. I just want to give you a few cents of what I do, and I have on here lowering your cost basis or making dividends, making extra money on the shares that you currently own. I mentioned this a while back on a FUBO call or one of those X calls in regards to if you have a whole bunch of shares and you don't want to put any more money into your position, might be a good idea to sell some covered calls just to lower your cost basis. Now, I'll tell you at the end whether I think this is still a good idea or not, specifically on FUBO, but I'll show you the other day. On Thursday, I sold quite a bit of covered calls on some of my long-term positions in my IRAs on other stocks and show you how much I made just in one single day with a few clicks. Okay, so let's get into this. All right, first, for those that don't understand, what exactly is a call? So a call is just a contract that gives the buyer of that call the right, that now you have to execute that right, to purchase a stock at a set price, and that set price is the strike price that you buy the contract at, within a set time period, and that would be the expiration date, if that underlying stock reaches or exceeds the price or the strike price at any point during that time period. So at any point where the stock price is above your strike price, you can execute that call and call shares away from somebody else at that certain price you'd agree to pay on. So if you sell a call at $35 and the price of the stock is $50, well, you only have to pay $35 for that stock, and immediately you have a stock worth $50. So the buyer of the contract must pay a premium up front to the seller of the contract, and the seller will keep that premium regardless of the outcome of the contract. So that's very important in selling calls, is that you do receive that money right up front. So the buyer can execute the contract if the price of the underlying stock is above the strike price, which we talked about, prior to the expiration date, and the seller of the contract must sell 100 shares per contract of the stock to the buyer at the agreed upon price. So in order to do these covered calls, yes, you do have to buy at least 100 shares of a stock or have that. So I always look at the stock price or my position in multiples of 100. I try to buy stock in multiple of 100. I think ahead because if I were to want to sell calls, I have the option to do so. Now, maybe it's too expensive for you, right? And you just can't do that because of the cost per share. But I would say with a stock like FUBO, where it's currently sitting, you only need like $300, right, to get 100 shares of that stock. So most people that are listening to this will be able to do that. So you will purchase a contract from someone selling. So when you're going in there to purchase a call, we're talking about this from the standpoint of someone that's purchasing a call, but this is really based on selling calls. We'll talk about that's what we're going to be doing. We're not going to be gambling here. We're going to be the ones playing the casino, playing the house, right? But you will purchase a contract from someone selling. So you're getting on there, you're looking to buy a contract, buy a call. Someone has a call that's, hey, for $1 per contract. Someone's there selling a call, right? They put it on the list saying, hey, I want to sell this contract for $1, and you're actually buying that from someone else that has put that on there. But your contract is not exactly linked to that exact person, right? So if you go back to try to sell your call that you purchased, you don't have to have them buy it back, right? It just goes into the pool back again, and someone else can buy that from you. And again, if a contract is executed, so if I have a call and it's above the strike price, and say, hey, yeah, I actually do want to spend my $3,500 to buy this $35 stock, even though it's at $50, well, if I execute, it doesn't go right to the same person I bought that call from. What it does is it goes to the CBOE, the one that deals with options, the options exchange in Chicago, and they randomly select a brokerage, and that brokerage will select an individual to assign that executed contract to, something that's in the money. Right, so a lot of people think, how does this contract get bought or sold if that other person doesn't want to buy it back? Well, that's not how it works. So the option can expire worthless if the buyer does not execute the contract. So say the stock price never gets up to that $35 range. Say it stays at $30 the whole time. Well, you bought that contract for $1. Well, you never could execute it. So it will expire worthless if you hold on to that. Now, you don't have to hold on to it for the whole time. You can get rid of it if that starts going down to 50 cents or 40 cents, which would be like $50 or $40. It's per share, right? So everything's multiplied by 100 for these calls. Then you can get rid of that for half the price and kind of cut your losses, right? So the buyer of a contract can sell it to close as well. So if the price of the contract goes up, this is what normally happens with calls, right? They can sell to make the profit without ever buying the 100 shares. Most of the time, this is what people do, right? So, or if the price goes down, they believe it will keep going down, they can cut their loss like we just talked about to expire worthless. I guess I should be putting this on this, right? There we go. Make it full screen. Sorry, guys. Okay, so selling options. When you sell a covered call, there is little risk. Let me repeat that. I hear this a lot. I don't want to get into options because it's too risky. Let me tell you something. Selling options is the less risky thing, or the least risky thing you can do probably in all of stock. Holding shares sometimes is even more risky than selling covered calls. Or selling puts, which we'll talk about maybe in another video, to get into a stock. You can actually own a stock with a cost basis way lower than it's ever actually been. And that'll be a little trick we'll talk about in another video. But for now, we're talking about covered calls where you actually own the shares. The only risk is missing out on an upside potential. So if you see that as risk, then I guess maybe it is risky, right? So if you're selling calls with a strike price that is less than your cost basis, say you bought, FUBO at $10 and it's currently at $3 something, right? And you're selling a call at $4. Well, if it calls it away at $4, you're losing $6 per share. So I guess that could be risky. You probably don't want to sell that unless you just are really confident that's not going to go above $4. The other way too would be to keep rolling that contract out and up. And again, we can talk about that towards the end of this video. Another small risk is holding onto a stock that is going down simply because you are selling calls against it. So another thing would be, hey, yeah, I sold a call at $4 and it expires next month and the stock is going down and I can't sell my shares because I'm in a call contract. Well, you can simply close out the call contract. The price of that the contract will absolutely go down. So you could have sold it for $1. It might now be at 20 cents. So buy it back at 20 cents. You still made 80 cents and then immediately sell your shares if you want to get out of it. So really there's no excuse for that being a risk because you'll still be making money on that call. Now, when selling cash secured puts, there's also little risk if you were thinking of buying the stock anyway. Say you're buying a stock or there's a stock that's at $50. You're wanting to buy it at $40. So you sell what's called a cash secured put, saying if the stock goes below $40, it's going to be put to you at $40. So you'd have to have $4,000 in your account. And when you sell that cash secure put, you might make a few dollars or $1 or so, $100, $200, whatever that may be. And if it goes to $40, well, you could put the shares at $40. Now, it could go way below that to like $30. But if you were going to buy it anyways at $40, well, you still would have had the stock at $40 and it's now at $30. The only difference now is you bought it at $40, but maybe your cost basis is like $39 with the premium added to it, right? So it's a little bit less. So again, the stock could slide further below your strike price and you would have sold prior to it reaching the price it would be at when you are put the shares. I guess that's one thing. If you're locked into this put contract and the stock keeps going down to like 30 and you're like, oh man, I wouldn't have held down to 30. And now you get put shares at 40 and immediately the stock, if you have to turn on and sell it, is at 30. So there might be a little bit more risk, I'd say, in selling cash secured puts. But again, if you were going to buy that stock anyway, it might not be as risky as you think. So I still think there's little risk here when you're selling any sort of options. Okay, so selling options, think of this. So think of it as you are the casino and you are the gas station selling lottery tickets, right? Or you're selling the game that you're playing, right, at the casino. So others are making their bets that a stock is going to go up, like for a call, or down, like for a put. And you're simply cashing in on shares you already own. So you are cashing in, waiting for a stock to drop to a price you already want to own it at, which is for like a cash secure put. Or you're okay selling a stock at a price that you were going to sell at anyways, and you're just cashing in on that extra premium that you're going to get from someone betting on it. Now, the main thing we need to do is figure out when the best time is to sell a call. All right, so I want to show you guys something here. This is what I did in one of my accounts, right? I have multiple accounts. This is one of my IRAs, my Roth IRAs that I have. Just to let everybody know, you can convert a traditional IRA. You can do some backdoor conversions to a Roth IRA. If anybody has any questions on how to do that, you're like, oh, I make too much money, I can't get a Roth IRA. That's incorrect. Drop a comment. Let me know if you need some help on that. I can help you out with that. I'm not a fiduciary financial person, but I've done it many times. I do it every year. It's easy to do. All right, so I sold some calls. So these are covered calls because I have that amount of shares. So if you look here, I sold 5 covered calls for ACHR Aviation, a strike price at 14. 2 covered calls for PayPal, a strike price at 75. 8 covered calls, so I have to have 800 shares here, 200 shares here, 500 shares here of SOFI, 1 on Invisalign. And you see the strike price. So if it goes above these strikes by 620, so it's a little bit more than a month out. This is sort of my sweet spot. I like to sell these roughly 30, 35 days out if I feel like we're kind of toppy, right? And I think we are for some of these stocks. And I like to look at the chart. And I also say, hey, am I going to make a lot of profit if it sells at that? And if I am and I'm okay selling it, then I'm okay. So, excuse me. So the premium I received on Thursday was $1,377.39 minus the transaction fees of 30 cents per contract. I can't remember what it is, of $10. So roughly made $1,366.78, all from stocks I already own and at strike prices above my cost basis for all of these stocks. And it took me maybe 3, 4, 5 minutes to figure this out and do this. So again, if you're looking to make some extra money on the side, I'd say this is a good way to do it. So we'll go through each of the stocks, tell you what I did, show you some examples of how I look at it, which I think is different than probably a lot of people. Maybe it's not. Drop a comment. Let me know if you do the same thing, right? But from when I've talked to a lot of people, they just see it as a way to make some extra money. I look at it as a way to lower my cost basis. So I bought 500 shares originally of ACHR at $4.45 in this account. In fact, you know what we'll do? I'm going to just see what ACHR is right now. So currently it's at $13.30, right? So I bought these at $4.45. So I'm quite a bit up, right? So I sold 5 calls. Remember, one call is for 100 shares each at 60 cents. So times 100 shares, right? So a little more than a month out. It's at June 20th is the expiration date. So I got $60 per contract. So 60 times 5 is $300. The strike price is at $14. That's 214% above my buy price. So am I okay selling this at that price if it were to hit at this time? Yeah, sure. Now the current price now is $12.75. When I sold, it was around, I think, $11.75. I didn't calculate the exact time and what the price was. I didn't go back and look, but we'll just say it was around $11.75. So at the time, the stock needed to go up about 20%. So right now, currently, at the price that it's at, it can go up even another 10%, and I'd still be okay, and it would call it away. So I'm going to show you the chart, right? Now, when stocks are gapping up and at resistance with a high chance to come down soon, this is a great time to sell covered calls. This is when premiums are usually really high because the volatility is going up. Everybody's thinking the stock is just going to keep going up to the moon. So this is when the gamblers come out, right? The people that don't know how to read a chart. The people that think things just keep going up. But we know stocks don't always keep going up, right? So this is where we need to ask everybody to come to our casino, ask everybody to come to the gas station, display, hey, we're selling lottery tickets, right? So let me show you. All right, so this was Thursday right here. These are daily candles. And as you can see, this is kind of a top, right, that it hit back in January 7th, 2025. So I saw we were like, hey, way above on the RSI that day. We're looking at an RSI of 78. Anything above 70 is usually overbought. So, of course, I sold it thinking, hey, we have a good chance of going down. If it goes up, we can't go up too much more. Well, I kind of was wrong on Friday. It did keep going up, but the good news is, if you look, what do we sell it at, right? Our Archer we sold at $14. Okay, so I still have some ways to go in order for this to be sold. Another 10% higher, right? And it's already been gapping up. Look, it's gone up 22%, 6% if we're looking up in this area and how much it goes up, right? So the 13th, 22%, 6%, 2%, 9%. So eventually, I don't know if this thing can keep going up. If it does, again, I'm okay taking a 200% profit and having it come back down and buy it again, right? All right, so that's one way to look at it is look at the chart, see when you're oversold, see when things are going up, look at resistance lines. Yeah, maybe we could lower this down a little bit and say, hey, maybe we're at $11.70 something cents. And again, I think that's kind of where I sold my call, was when the price was at this area, right? All right, so we talked about Archer when stocks are gapping up. Another way to look at this is that you are decreasing your cost basis by 60 cents per share in Archer. So remember, I bought it at $4.45. So if we just take away the 60 cents per share that I made on it, we can manually do this. I keep a note on my phone, and I put all the stocks I own, and I put my cost basis. It will not do this for you automatically on any brokerage that I know of. So this is the difference that a lot of people don't look at. So if I subtract the 60 cents from the 445, now my cost basis is $3.85. Now, again, it's not going to show up like this, but the cash went into my account, right? I can just use that, put it to the side. Immediately, I can buy other stock with it. But we can look at it similarly, like we just lowered our cost basis, that we didn't spend that money on buying that stock. So in 6 or 7 more months, if you multiply this out, right, 7 times 60 would be 42, so $4.20. We can have this cost basis at like 20 cents per share, right? So in about 8 months, it absolutely would be $0. So start looking at these smaller stocks, especially under $10, when they're really volatile like this, is a perfect time to sell covered calls, because you could theoretically, within a year, have free shares, right? This is where a lot of people go wrong. They don't look at this the way that you should look at it. I did the exact same thing on SOFI when it was floating around $5, $6, $7. Lower my cost basis, maybe under $2 at one point on one of my accounts. You can definitely do this with FUBO. I don't know right now if I'd start doing that, if we're looking at maybe a 2-month window where they could technically approve this merger. Maybe it's not smart to do it because it can gap right through it. Here's another thing I'll tell you now, that I don't ever sell calls on all the shares that I own. Now, this is just one of my accounts. So if it goes down with this one, the other account, I'm not selling covered calls on it. So that way I always have shares that will keep riding just in case it does, quote unquote, go to the moon. So another way you can look at this is look at your percent return on the current price that it's at, right? So say you were just to sell the stock, so you sell a stock at $10, well, you can maybe use that $10 and go and put it in the bank and make a certain percentage off of it, right? So say you sold this and put it into a savings account yielding 0.1%, right? So you can make 0.1% on your $10. Now, if you kept your 100 shares at the current price of $11.75 and you made 60 cents per share on that, right? That's what we sold our contract for the call. Your percent return would be about 0.6% for that 1 month. I sold it about 30-something days out. So we're making 0.6% in 1 month, right? So that's the return on this $11.75. Say we're to just sell that $11.75. So you multiply that by 12 to get 7.2% annualized return. That's much better than sticking it in or buying a treasury bill, right? 7.2% is much better than that. I will tell you, normally, I want this percent return for a month to be anywhere from 1 to 2%, because I want to make 12, 20% per annualized return on a year, right? To be honest with you. But on this one, again, I'm super up on this. This is already a multi-bagger for me. So I don't really care, right? Anything I'm making now is just gravy. I'll show you on every single stock what I have and that I just sold covered calls on, and you'll see. So stocks I don't want to get called away and I'm already up big on, I can push the strike price out further and make less and still be okay. Again, the further out you sell that call, your premium is going to go down. So if the stock is currently at $12 and you're selling a covered call at $20, you'll probably hardly make anything, right? But if you sell a covered call at $13, you'll be making a little bit more. Selling right at the money at $12, you'll make a lot. And you can sell calls in the money. You'll make a lot of premium, but you're almost guaranteed for that stock to get called away. Not almost, but you have a higher chance, right? All right, let's put it here. All right, so PayPal. On this account, I bought 200 shares at $63.10. I've been buying and selling this thing like crazy. When it goes up, sell. When it goes down, buy more. I think I've owned PayPal and got rid of it 3 or 4 times. So I sold 2 calls at $1.30 for a little more than a month out. Everything I did is June 20th, right? So I made $130, okay, per contract. So $260 premium. The strike price was $75. So it's I bought them at 63. I guess we should see what PayPal currently is at right now, just so you guys can get an idea. Let's do that. Okay, PayPal currently at $72.18. Should have put that in there. That's okay. All right, so it's currently at $72.18, so only a few dollars higher than what it currently is, right? So this would still be a 19% profit on my original share price. So it's still 20% profit, close to it. Oh, I have it right here. Current price, selling a call. Oh, when I sold the call, it was $72.50. So the yield, so $1.30 divided by $72.50 will be 1.8% per month. Now this is really good, right? Remember, I really want 1 to 2% per month. Multiply that by 12, you have about 21.5% annualized return on stocks that you already own. Let me remind you guys, you're not putting extra money into anything. You are just selling calls on stocks that you already own, and you're making money on it. There's really no other way that I can think of to make easy money that I know of. And I've looked at a lot of things. This seems to be one of them, okay? So just putting that out there, and this is why I stress this so much on people that never heard of it. They don't teach this stuff in school. They don't probably teach it to you in finance school. I never went. But most people tend to think this, options are too risky. I'm here to tell you otherwise. So we can look at it again on cost basis. Again, I'm sitting here and I'm manually putting this out. It takes 2 minutes to do, right? So I have my 63.10. I subtract $1.30 from it. Now my new cost basis is $61.80. So I lowered my cost basis by 2% in 1 month. So I could, if I did this every month for 12 months, I could lower my cost basis by 24% in 1 year and never have to, quote unquote, average down by putting any more capital or buying any more stock. So this is the power of covered calls. All right, a few more here. SOFI, bought 800 shares at $8 in this account. Again, I have multiple accounts where I've had SOFI and have owned it a lot lower than this. So sold 8 calls at 40 cents for June 20th, expiration date, $40 per contract, times 8 is $320 premium. The strike is at $15. Okay, the price when I sold the call was $13.75, so just a little bit higher than what it is. Now, that's an 87.5% profit on the $8, okay, if it calls it away from me at $15. I'm okay making 87.5% profit on SOFI. I don't want to get rid of it. I think it still can go higher, but I would be okay with it. And again, I'll show you all later, I can still roll it out and up, and still hold on to these shares. There's ways to do it. Okay, if you really want to know. The yield, so $1.30 divided by the current price would be 2.9% per month, or 34.9% annualized return on the cost of these shares, right? Or the cost basis would be $7.60, and I lowered it by 5% in 1 month. So multiply it by 12, I could lower the cost basis of these $8 60% in 1 year. And it's already $8, right? So theoretically, in a year and a half or 2 years, your shares could be worth $0 and you can have free shares simply by clicking a few buttons per month. All right, Invisalign. I'm a dentist, so this is a stock that I do follow. I believe it was undervalued at one point. I still think it is. About 100 shares at $191 in this account. Luckily, I have it a lot lower in some of the other accounts I have. I sold one call at $5.35. So I got $535 for just one call. The strike is at $195, a little bit above, right, what my cost basis is. I hardly ever sell calls below my cost basis, but there are times you can do it if you don't believe it's going to hit that, and you just need to average down your cost basis. That's 2% profit on my original shares, which doesn't seem like much, but when you have $19,000 in something, 2% is still a pretty good return, right? Now, I'm currently down on this position because when I sold the call, it was at $185, and again, I bought it at $191. So I'm okay to make just a little bit on this, right? My cost basis would be, again, we look at the yield 2.9% or 34.9% annualized. Cost basis at $185.65 if you subtract $5.35 from $191, or I lowered it by 3% in 1 month. So in a year, I could lower this cost basis by 36%. Essentially, if this thing gets called away, I'll make $1,000 in a month, right? If this is called away at $195, right? Because my shares now are $185. It gets called away at my strike price of $195. So roughly $1,000 in a month, which is not too bad. All right, I guess I'll show you guys how to quickly sell a call. Maybe most of you guys know, but I'm sure there's someone out there that has no idea. And like, I don't know what to do. If someone were to teach me, I would do it. I'm going to show you. Now, on most brokerage accounts, I'm using Thinkorswim, the web browser one. It's pretty simple, straight to use. Almost on every brokerage account, you can find a stock. If it's selling an option or it's optionable, it will have an options chain. Click on the options chain. Then you want to go to what date that you want to sell your call on. Like I said, again, I try to go a little bit over 30 days. You'll click the drop down. Puts are going to be on the right side. We're not going to worry about those today. Calls are always going to be in the left, right? Now, this line right here is usually at the money. In other words, that's closest to where they're selling. This one's every $2.50. Every stock is a little bit different. That's going to be as close to the actual price, the current price, right? That's at the money. So anything in the money is going to be this grayed out portion. So if you sell a call in the money, you're going to be making a lot more premium. This is your bid and your ask, right? This is if someone's like, hey, I want to buy it at $3.95, and someone says, hey, I want to sell it at $4.05. Well, that's your bid and your ask. That's also called your spread. All right. The mark is simply the average of these two, what's in the middle of it, right? I just have this on my settings. You can go to your settings and change and add and drop anything you want. I usually just have your simple stuff. I just have a bid and an ask. Your probability in the money, I never look at. I don't think it really matters, to be honest. It's just saying, hey, this is the probability that this is going to actually hit. That's never right. That changes all the time. The mark is the midpoint. The last is the last time someone sold or bought that contract. It happened at this price. Your delta is how much this contract is going to change with every dollar move. So if this goes from 70 to 71, that means it's going to change 61 cents. So that $4 or the $4.05 might go up to $4.66, right? When that stock price goes up from 71 to 72. Open interest, this means at the end of the day, how much contracts people were still holding. Okay. The volume is how much transferred during that day. How many were bought and sold, right? This is how many that are held on to at the end of the day. Which I do look at this sometimes and say, hey, that means the market makers might be holding on to a lot of these contracts. So as soon as it gets above 70, a lot of people are going to be selling those off to make profit, and it's going to push the stock back down, right? The higher the number, meaning the more that are open interest, it's going to be tough. That's almost going to act like a wall to this stock. That $70 stock 30 days out, it's probably might not get to it. Again, remember I sold $75 calls, right? And there's still a lot of open interest there as opposed to the puts. Not that many puts, right? A lot of calls sold, not that many puts, right? So this is going to be a huge wall to get over. Think of it as market makers selling a lot of calls. They don't want it to get over 70. Market makers selling a lot of $75 calls. They don't want it to get over there. They're going to start pushing it down, selling the stock to get it underneath it. That's one way you can look at it, or just organically, people are going to be selling those contracts, which is going to push the stock down. All right, so if you want to buy one, or sell one, all right, we have a stock that we want to sell $75, right? So we can go here, or maybe let's do 75, right? Again, we want to at least make 1% or 2% per month. So if we were to say $1, let's look at the mark, 143. So we'll do 143 divided by 75. Gives you 1.9%, right? So that's really good. That's what we want. Anywhere from 1 to 2%. That's what I like. You can change yours based on your strategy. So you're going to go over here to the bid. This is what someone's going to be willing to buy. Click that. It's going to say sell one contract for June 20th, 34 days out at 75. Again, this is your bid and your ask. Your mark is going to be right in the middle. You can do it right at your bid if you want, or try to make a few extra bucks selling it right in the middle. Now, this is Saturday night. Market's not opening. Normally, this is fluctuating back and forth. Stock prices going all over the place. So it will change, and it's going to be fluctuating. So if you just want to sell it, you don't care about the extra $3 to $6. You just hit market. It's going to just probably sell it. Now, I have Schwab and Thinkorswim, so it's even if I do market, it's probably going to try to give me the best price. If you have something crappy like Robinhood, sorry guys, but it is. It's probably going to sell it at your 140 or lower price, right? But just putting that out there. But I always do limit. I put it in the middle, hit review. It's going to tell you down here, you're going to make $143. You have to pay 65 cents per contract, which in the scheme of things is nothing. You'll make $142.35 credit. As soon as I hit send and that contract is bought or sold, you will immediately get this $142 credit into your account. You can use that to buy a leap call, or probably not $142. But again, saying you could buy a call on this. You could use it to buy 2 more shares almost of this. You could use it to buy another stock, right? Or just hold it in your account. So again, I'd hit send, but it's not going to do anything. But you would just hit send. It would go through and transaction would happen. And then you just get that extra money. Now, if you went to try to sell your 100 shares, it's probably not going to let you. It's probably going to say error. This account doesn't allow you to do that, depending upon your margin status, because it's not going to allow you to have just like a naked call that's sold, right? Because then it's going to say, hey, well, you don't have the money to do that because you don't have the shares that are covered. Okay, so that's how you would sell a call. Hopefully that makes sense. If you have any other questions or need me to go over a certain account or brokerage account, I'll be able to help you out with that on pretty much any account or any brokerage. Just let me know. They all pretty much work the same though. All right, so here's an example of like lowering your cost basis on like FUBO, because that's what we've been talking about. That's what I mentioned many months ago when I thought it was a good idea. Now I still think you can do it, if you're okay getting rid of your shares. But that opportunity is huge if it were to double overnight, right? You're going to sell a stock or sell a call maybe 20% or 20 cents higher, and it jumps up $2, and that potential you can miss out on could be really huge. The only time you'd want to do this maybe is selling through an earnings. Like the last earnings or two, you probably could have done it because your premium is going to be a lot higher. Now those earnings have kind of been squashed a little bit, right? Because we don't have that coming up here soon. But let's just say you had $10,000 or 10,000 shares at $3.55. That's when you bought it. So the total cost is $35,500. You can sell 50 calls, which would equal about 5,000 shares or half of your total shares amount at a strike of $3.50 and a premium of 18 cents. And we can show you right now that that is actually true. If I were to go to FUBO here and go to the options chain, go 35 days out, go to 3.5, go to the mark right in between your bid and ask, you're going to make about 18 cents, which is like $18 per contract you sell. All right, so you do 50 times $18, which means you make about $900 in premium. It's an extra $900 that you're not going to make just sitting there, right? So again, you'll have $35,500, which is your original cost basis total. You subtract $900 in premium, assuming, remember, it's like you're not spending $900 that you would have, right? So you'd have $34,600 total invested into these 10,000 shares, or $3.46 per share. So you've lowered your cost basis from $3.55 to $3.46. Again, may not sound like too much, but when you're dealing with a stock that's under $5, every cent really adds up. So you've lowered it by 2.5% in 1 month. Okay. And if you multiplied that, by 12, right? You're 24, 6, 30. You can lower your cost basis by 30% in a year if you just did this. If you really think, hey, it's going to take over a year for this merger to go through and you truly believe that, you could lower your cost basis by 30%. And some of you guys might only be down 30%, right? So you could literally get your stock back to being break even simply by selling covered calls on, again, not even all of your shares, only half your shares. So the other half of the shares can still benefit from any pops that you may have. All right, so you still keep 5,000 shares in case the others get called away. During or through, like I mentioned earlier, earnings are a great way to get a lot of premiums. Again, a lot of times it'll pop, especially when it's not merging, right? It's not going to, if we think, hey, they're not going to announce a merger through an earnings call, that you can capitalize on the premiums. And I will tell you, I did do this. I've sold calls through these earnings, capitalize on any pops. But if they just drop immediately, that's almost instant 100% profit on those calls because they're just not going to hit, right? Let's go to the next. All right. So the next thing we may have to do like on a live session where I can show you exactly what it looks like. But let's just say you have a stock that you own, you sold a call, and say it went above that price. Maybe I will just give you an option, see if what it shows, right? You can actually roll that. In other words, you can buy back that covered call and sell it a week out, and maybe you have to pay a little bit of money, but again, if you're rolling it out another $5, let's say, that's an extra $500 you'll make on the underlying share, per 100 shares. And maybe you'll have to pay $2.50. You might have to pay $250 to possibly make an extra $500. And if it's already like $5 or $6 or $7 or $8 above your strike price, it's probably going to happen, right? So I've definitely done this a few times. Let me see. Yeah, we'll get out of that. And maybe I'll show you to see if it's possible to do this. I'm not exactly sure. You know what? I'm going to get on my account. Let's see. Positions. We'll go to live trading, right? I'm not going to show you guys all my profit and stuff, but see if it'll make me. I don't know if it'll let me do it. Give me just 2 seconds. I'm going to be messing with this other screen here real quick. Okay. Not sure if it's going to let me actually show you something that I own or to be able to roll it. Let me see. Here's FUBO. See where I have something that I've sold a call on. Okay. This one might work. Okay. Sorry about that. Showed you all my accounts and stuff. Let's go down to SOFI. We'll click on this. So these are some calls, right, that I had sold on SOFI at $15. So if you click on your call, you can hit roll selected. So what'll happen is I'm selling it for June 20th, but let's say this, the cost or the price of the stock went up to $18. We're going to roll it. Like, hey, you know what? That $15 thing didn't really work out. So we're going to buy that back and we're going to sell it and move the strike price up to $20, right? Now, that's going to cost me at this point, it'll be probably much more if that were the case, right? But right now it'll cost me $46 to do that, right? To roll it up and out $5. But here's the thing. I can make an extra $5 per share, so an extra $500 just by spending $46. Now I have to wait an extra week, right? Because it pushed it out a week, 7 more days. But I also pushed the strike price out another $5. So this is a way to get out of a call of one that's going to call those shares away if you're in the money. Okay. So I was able to actually give you a little bit of an example there on one of these kind of fake accounts that I have. All right, or no, sorry, I'm on my actual real account. So you got to see it on my real account here. Trying not to show you all the prices and whatnot that I have, but if you saw it, you saw it. I have no idea what you saw. So hopefully this was very helpful for you guys on selling covered calls. The ability to lower your cost basis, which is a way to think of it instead of just saying, hey, I'm making money on it. Of course, you can look at it as saying, hey, I'm making dividends on stocks that maybe they don't have dividends on them. It's a way to get dividends. It's a way to make some extra money without putting any capital in it. It's also a way to lower your cost basis on stocks that you're kind of in the hole on, right? Now, does that mean you have to sell calls with strike prices below your cost basis for a little time? Yes, right? Just until you can get some of that cost basis down. But again, if it does pop up, I would never sell calls on all my shares if you really expect things to pop. Or you can try to roll those calls out for another week or another month and keep doing that until eventually the price comes down below your strike price. So those are a few strategies that we can use on selling covered calls. If anybody wants any more videos on selling cash secured puts, ways that I do that, I'll be happy to share that with you. All right, I'm signing out. Looks like FUBO's doing pretty good. Maybe I'm just going to throw up that chart. Last little thing. I said I'm leaving, but not yet. Not without looking at old Mr. FUBO. Okay, you can see we've been just kind of crashing down on these earnings, but we get really good consolidation here. It's not just tanking, right? We another crash down on earnings. But look, I mean, we immediately just started buying back this gap that we had, right? So we filled that gap very quickly. This kind of trend line, upper trend line resistance that we've had back from February 2025. Again, I don't know if these really count, right? But ever since we sort of consolidated and had this normalized volume is when I started making this trend line. And we touched on it twice, 3 times, and we've just completely demolished that on heavy volume, which we've had a lot more volume coming in since the last earning report. And we are now in the next gap, right? That from that first earnings back in February that we had the big gap down on. And to fill that, we need to go to a low 345. So we looks like hopefully we'll go up to 345 and fill that gap. However, we do have some resistance right here at the 330 if you put our EMAs back in or our moving averages. We mentioned I believe it was like I don't know if I have the exact same moving averages on here. I don't, as I do on my phone. But I think the 100-day moving average was like a 321. I think we are definitely having that as one of our resistance levels. We'll see what happens with this Moody's downgrade. If that means anything with any of these stocks, it might have a little bit of a sell-off. Again, with some of these stocks that are undervalued or have mergers, it's not going to make a difference. If they're going to merge, it's going to go up, right? So hopefully we get back to this 640. And then again, if you look way back, I mean, this thing can really start taking off, right? Just with hype. I mean, this is just way back before they even did anything, right? We have betting that can get in there. We have Disney. We have ESPN. We have a lot of good things coming on for FUBO. That's why, like I said, on my brokerage right now, I am all in on FUBO. If anybody else is all in, drop it in the comments. Let me know that I'm not the only one that thinks this highly, that this could do that. You've seen a few other multi-baggers that I have. Again, I wish I was probably all in on some of those. Again, I wasn't. I'm trying to learn my lesson, and when I feel heavy convictions on these things, to really put my money where my mouth is, and trying to be too stupid with it, obviously, but I think we're pretty solid here on where we're at, and I don't see, even if it doesn't go through, I think another suitor could come in, and I also think we're doing pretty good with where we're at just by itself. I think we can still be profitable. All right, now I'm signing off. Sayonara.